one example I use for compounding often is the issue of a penny doubled every day for a month for 30 periods. And that turns into $10.8 million. 1 penny turns into 10.7, 10.8 million in 30 periods, 31 days. That's the effect of compounding. And so when we're looking for businesses that do this, we want businesses that can reinvest their free cash flow back in the business to continue to earn the above average rates of return on that capital, and therefore compound the owner's capital.
That was Chuck AKRE, who you just listened to there, and that's who we're going to be listening to in today's video. We're also going to have a look over his portfolio in the end as well. For those who aren't aware, Chuck AKRE founded AKRE Capital Management in 1989 and has just shy of 20 billion in assets under management, and he has had some phenomenal returns over that time as well, averaging around 17.5% return since inception. So we definitely want to listen to what he has to say. He follows a lot of the same principles that the same investors that we like to look up to, much as Warren Buffett, Charlie Munger, Mohnish Pabrai, Phil Town, all these big value investors. Now, Chuck's only someone I've come across recently, as there's a company that he holds in his portfolio, which I've been doing a bit more research on recently, which we'll cover at the end of the video, so make sure you stick around for that. In this first clip from Chuck, we're going to have a listen to the 3 traits that he looks for in companies. He's often referred to this as the 3-legged stool. So let's jump over and listen to what he has to say.
The requirements for a great business for us have really 3 components. The first is we spend a lot of time trying to understand what's causing this above average return to occur. Is it getting better or worse? The second thing we look for are the people who run the business, and not only do we want to have great business managers, but we want to see to it that they treat public shareholders as partners, even as they don't know them. And then lastly, we look to see if there's a great history of reinvestment of the free cash flow, as well as a significant opportunity to reinvest free cash flow and earn above average rates of return. Those are the characteristics of the businesses.
Fairly easy to understand there, those 3 traits that Chuck looks for within different companies before they make it into the portfolio. In this next clip, we're going to have a look at why he favors companies that reinvest back into the business, so the return on the invested capital, rather than paying out dividends.
It's important. The average return in common stocks for nearly 100 years in this country is around 10%.
Right.
Whether it's 9 or 11 is of no consequence to us.
And that's dividends reinvested?
That's total return,
right,
absolutely.
Total return.
And so in our case, we look to be able to return above average returns, and we've done so for a very long time. And depending on which vehicle we're talking about, it's a different level, but substantially above that average return.
Chuck, why don't you favor dividends as much as many of the other great investors that I talk to do?
Well, we said at the outset that our goal is to compound our capital, and there is no free lunch. The management has 3 or 4 choices to do with all the free cash they generate. They can pay dividends, they can buy back stock, they can invest in their own business, or they can acquire other businesses. And so in order to compound our capital, the most efficient way to do that is to invest in their own business or another business where they earn above average rates of return. If they pay a dividend, they no longer have that capital to do that. And so it's marginally less efficient way for us to compound our capital.
So as well as applying the 3-legged stool to businesses that he likes to invest in this last clip, we're going to have a look at the key things that he looks for in the underlying business before he makes that investment. So let's jump on over and have a listen to that.
It's not a secret, it's really quite intuitive and straightforward, and that is the businesses which we own in the portfolio have more growth, higher returns on capital, stronger balance sheets, and frequently valuations which are below market. So just on the face, they have a below market average risk.
Tell me what you look for in an underlying business.
Well, American businesses probably have single-digit net margins on average. And the returns on equity, returns on the owner's capital, as I suggested, are probably in the low teens. So if we find a business, as we're looking around, that has returns which are significantly greater than that, that causes us to get curious about, well, why is that occurring? And so the simple reasons would be they have patent, or they have the absence of competition for one reason or another.
That's the moat.
Right, that's the moat, the frequent phrase that's used.
That Warren Buffett and
right, and
Ben
sometimes in a business we say, well, we don't know precisely why they're able to do it. This is what we think. and that's okay too. We've learned to get comfortable with that. And
Not being quite sure, but
right,
you
not
just know
being
they're
quite
doing
sure.
it.
This is what our hunch is. Management's, if it's something that's really a secret sauce, the managements are unlikely to share it directly with us because it invites competition. And if you have a business with very high returns, it will naturally invite competition. Everybody wants to get something that's got better returns than they have. And so, that's how we go about it. And we spend a lot of time trying to study other companies in that line of business or other businesses that are related and make our judgments that way. And what we are is we're investors in businesses, and we're trying to identify those unique businesses with very high returns, because at the end of the day, the core of our thought process says that our return in an asset will approximate that return on the owner's capital at the business.
Hopefully you guys got some value there, going over what Chuck looks for before making an investment within a business. To finish off today's video, we're going to have a quick look over Chuck's portfolio, and this is from the latest Q3 of 2021's latest 13-year filing, just to see some of these companies that he has within his portfolio. So now if we scroll down, we can see the top position within his portfolio is MasterCard, followed closely by Moody's, and these both each make up around 12% of the portfolio. And he's had a number of these positions within the portfolio for years. And if we keep scrolling down, one of the most recent additions was Salesforce from memory. Haven't looked too much at the company, but down at the bottom of the list, we're going to be looking at Ollies Bargains Outlet. It only makes up 0.19% of his portfolio, so it's a very small portion of Chuck's portfolio. But we're going to have a quick look at that, as it's come on my radar recently. Now, he's been buying into Ollies Bargain Outlet back in Q3 of 2019, and he was buying around $58.64. That was the reported price at that point in time. And then he added to it over the Q4 of 2019 and also Q1 of 2020. And over these last few quarters, he hasn't sold out of that position at all. So he still holds Ollies Bargain Outlet within the portfolio. As far as we know, we don't know what's happening with Q4. He may have sold out, but up until Q3, he held this position in his portfolio. We're going to have a quick look at QuickFS. To have a look over Ollies, just a very high level, couple of minute look, and that's going to pretty much wrap us up for today's video. So over here on QuickFS, which is a great tool to use if you just want to have a look at the high level look over some of the numbers for the company. So if we just look on a price to earnings multiple, they're currently trading around 17.8, which is historically about the cheapest they've ever traded on an earnings multiple. Return on assets coming in at 8.1%, return on equity at 12%, and return on invested capital coming in at just shy of that magical 10%, coming in at 9.9%. This is over the 10-year median returns. The EV to EBIT multiple coming in at 12.6. Now this is what Tobias Carlyle looks at. This is the acquires multiple. Another good thing to look at when you're analysing businesses at a very sort of high level look before you start digging a bit deeper. This is what I generally do. I have a high level look over some of the numbers. If I like what I'm seeing there, then I will move forward and start looking a bit further into the business. Now, if we look at the top line revenue growth over the last 8 years, they've grown from 2014, they had 541 million in gross revenue, and if we can look out to 2021, they're coming in at 1.8 billion. Fairly substantial growth over that time there. Gross margins have been very consistent, around the 40% over that same time period, as well as the operating margins as well, sort of hovering around that 10%. And in the most recent year, 2021, coming in at 15.3%. Also, earnings per share has grown from 36 cents in 2014 to the most current quarter, coming in at $3.68 earnings per share there. And then we covered off on the return on assets, return on equity, and return on invested capital. Over these last couple of years with the pandemic, they have had some pretty good returns as well. As they weren't forced into close, they were still managed to stay open throughout the pandemic as well. That's going to pretty much wrap us up for today's video, guys. If you'd like to see a future video where I sort of do a bit more of a deeper dive into Ollies, definitely drop that in the comments below and I'll do a follow-up video on that. Justin over at J Money has made a couple of good videos on Ollies, so I definitely recommend checking those out if you have not seen those yet. With that said, I'd love to hear from you guys. Do you guys follow Chuck at all? I definitely think moving forward I will be following them a lot more closely on his 13Fs. In the past I haven't really sort of followed them too closely, but I think I will be following them moving forward. And it's something I probably will cover on the channel as well. Anyway, with that said, that's going to wrap us up for today's video. Thank you for your time and we'll catch you in the next video. Cheers, guys.